You've likely heard by now that the Trump's One Big Beautiful Bill has passed. But what does that mean? There is so much in this bill, so much to unpack and so much to go through. We will not go through all of it in this video because that would take hours to go through. What we are going to do is go through the key provisions, the things that changed and the things that will affect you the most. Everyone in the United States is going to see one change or another in their taxes, and most likely those taxes are going to decrease. There are lots of provisions for individuals, lots of provisions for business owners, and so we'll go through these. We'll start with the individuals because the individuals provisions apply to everyone. They apply to business owners as well as non-business owners. Then we'll go through the things that apply to just business owners, but we'll spend a few minutes just kind of going through things and helping you understand how your taxes will be different going forward. The thing that's important about this bill is that it takes effect in 2025. So when this bill was signed by President Trump on the 4th of July, there were a lot of provisions that were effective for the 2025 tax year, which means you don't need to wait until 2026 to realize a lot of these provisions. Some of them happen immediately starting right now. So I've got my printouts here. We'll kind of go through these provisions and talk about the changes and what's going on with them. So the first one, the biggest thing was back in 2017, before 2017, the tax brackets were higher. Everyone was paying higher levels of income tax. When they passed the 2017 Tax Cuts and Jobs Act, all of those income tax brackets were adjusted downward, so everyone was paying less tax. Those tax brackets were set to expire at the end of 2025, which meant in 2026, everybody's taxes would have automatically increased. So one of Trump's biggest things was to extend those tax cuts, those lower tax rates, and that's what happened, is that those lower tax rates, so, for example, there used to be a 15% bracket. There is no longer a 15% bracket because that was moved down to a 12% bracket. The top tax bracket was 39.6, and that was moved down to a 37% tax bracket. So one of our biggest changes that we see is that it's not really a change at all, but it's just a continuation of these lower tax brackets. Had those expired, it would have been a huge increase in tax for everyone. So since we're just kind of keeping things steady, what did change? What are some things that will actually save people money on taxes? Well, the provisions that Trump ran on were three main things. It was no tax on tips, no tax on overtime, and no tax on Social Security. All three of those are, in one way or another, a part of this bill, a part of this One Big Beautiful Bill. There is no tax on tips, and there is no tax on overtime. However, there are phase-outs of that based on income, and there are limits based to the specific amount as well. So when it comes to our tips, you can deduct up to $25,000 of tips per year, and when it comes to overtime, you can deduct up to $12,500 in overtime per year. Now, what that means is that let's say that you make $100,000 during the year, and you earn $5,000 in tips. Well, that means that your total income that year was $105,000. $100,000 from your income, $5,000 in tips, $105,000. So the tax law actually still requires you to report the entire $105,000 as income on your return, but then there is a line item that allows you to deduct tips. So that tips of $5,000 will then be deducted, which means you're only taxed on the net $100,000 of income. Now, something interesting here is that tips run through payroll. Same thing with overtime as well. The overtime has a smaller provision, only $12,500, but it would be the same kind of concept. Like if you were paid $100,000, earn $5,000 in overtime, you'd still report the whole $105,000 as income and then take a deduction for the $5,000 in overtime. Now, both of these provisions, like I mentioned, run through payroll, which means that you still pay payroll tax on overtime and payroll tax on tips. You just no longer pay income tax on those up to those limits that we mentioned. Now, Social Security is kind of an interesting one because they couldn't really exempt Social Security from income. They couldn't just say it's not taxable. So that one also has to be added as income. It shows up as income on the return, and then a deduction can be taken for the Social Security. And the Social Security they're basically giving seniors an extra deduction. So with the Social Security, seniors can deduct $6,000 if they file separately or single as an individual, or $12,000 on a joint return, and then that also phases out at higher incomes as well. So you can debate whether Trump kept his promise and there's no tax on tips, Social Security, or overtime. Those are all provisions in the bill. Certain people will not pay any tax, income tax anyway. There'll still be Social Security tax, payroll taxes on the tips and overtime. Now, another big provision of the bill was that it actually raised the child tax credit. The child tax credit has been at $2,000 for a long time, ever since the 2017 Tax Cuts and Jobs Act. That was raised to $2,200. So every child, every dependent you have, that will be increased by another $200 deduction that you can get there. Standard deductions also went up. This year they were supposed to be $15,000 for a single person and $30,000 for a married filing joint. Those were raised to $15,750 for a single person, so it went up by $750. And for married filing jointly, it went up to $31,500, so that went up an extra $1,500 there. A big issue in the tax bill was what's called the SALT, the state and local tax. That's, for a long time, had been capped at $10,000, which meant people could only deduct up to $10,000 in state income tax, which include property taxes, vehicle taxes, and other sorts of taxes that were paid to a state or a local taxing agency. The big issue with that is that a lot of the high tax states like California and New York were not able to deduct all the taxes that they paid there. So people fought very hard for this one. This actually ended up being the big sticking point in the bill that took a long time to work out. But the SALT cap, the state and local tax cap, was raised to $40,000. So rather than being capped at $10,000, that's now being raised at $40,000, which for anyone that itemizes and pays over $10,000 in tax, that immediately will cause a tax savings for them to come through. Now that's a lot. And then one of the really big provisions for individuals was the auto loan interest. So I've been practicing for over 20 years as a CPA. Never have I seen auto loan interest other than for business owners. Business owners that use a car for business can deduct auto loan as a business expense. However, individuals have never ever been able to deduct auto loan interest on their personal tax return. That provision made it through. So individuals can now deduct up to $10,000 of auto loan interest. There's some limits and things on there that we'll go through in some other videos and things, but that is now in there, that you can deduct auto loan interest. There's also accounts for child savings, these Trump accounts for child savings. It's a one-time $1,000 credit to account per child that's born between 2025 and 2028. And then another really interesting provision that's in there is the ability to deduct charitable contributions when you don't itemize. Generally, in order to deduct charitable contributions, you have to itemize your deductions. Well, this One Big Beautiful Bill has allowed people to take a charitable deduction even if they don't itemize. And it's $1,000 for a single person and $2,000 for a married filing joint. And they've made that permanent. So that's permanent after 2025. So those are great provisions, helpful for individuals. What about on the business side? The businesses will see a number of benefits as well. The biggest one for businesses that everybody was keeping an eye on and watching is the bonus depreciation. For years and years, we were able to just expense 100% of any fixed assets that were purchased, such as vehicles or equipment or things like that. That started to being phased out over time. In 2025, it was down to 40%, that you could only deduct 40% of the equipment that you bought, and the rest had to be depreciated over a period of years. Well, the big news is that the this one big beautiful bill extended the bonus depreciation. We carried it all the way back to January of 2025, so January of this year, and that goes all the way to the end of 2029. We have 100% bonus depreciation back. The other thing is that for the 2017 Tax Cuts and Jobs Act implemented the 20% pass-through deduction. The pass-through is called the QBID, the Qualified Business Income Deduction. And it basically allowed business owners to take a 20% deduction on any business income. So if a business owner made $100,000, they could take a $20,000 deduction and effectively only be taxed on $80,000 of that income. Well, that was preserved and extended, so we won't see that going away, which is really good news. The other thing is that R&D for companies that do research and development, that was set to the 2017 Tax Cuts and Jobs Act started requiring that to be amortized over time. The good news is that that's being pushed back and allowed to be fully expensed in the year. So if you have R&D expenses, research and development expenses, you can go back to expensing those now. So those are some of the key provisions for individuals as well as for businesses. Like I said, there's a lot in this bill. There's a lot that we'll be learning about over time. There was the elimination of a lot of the solar and energy tax credits that were in there, such as the credits for vehicles, like the electric vehicles. That was one provision that particularly made Elon Musk not super happy with what was going on and caused some of the rifts there, I think, with Trump. But those start to phase out and go away completely fairly quickly here by the end of the year or sooner. So yeah, there's a lot of things in that. We'll continue to unpack it, but wanted to give you some of those key provisions so that you can start planning ahead for that. It might be time to kind of update withholdings and things. The employers should be doing that automatically as these things roll out to them. But it should equate into more money in people's pockets, being able to keep that and being able to support families and other things of that nature. So make sure you subscribe to our channel. We'll continue to bring you updates, and will help you to navigate these tax law changes and things that are going on there. So, and also go to our website, taxtutor.com, and you can subscribe to our newsletter.